all norms of technical analysis like RSI and so forth will be a total falsehood if you follow them. In other words, once you get silver up to a monthly RSI that's overbought, if you get out there, you're going to miss the move. Momentum of that is already pushing at the breakout levels, and usually momentum will lead a spread chart breakout. The pullback, I think, is probably largely spent, if not totally spent. In fact, that was like a week or so ago. If you'll just notice what's going on, like weekly close to weekly close, we're wheel spinning. It's not really going down, down, down. It went down, and then it's wheel spinning. When we examine the short-term technicals of silver, like the day-to-day, week-to-week type stuff, it's building a base, which you can't quite see it on the price chart, but on weekly momentum, I could see a clear ceiling that's been built, such that, I'll give you a number, it's tentative right now. You get these silver back above about 48.09 next week. Okay, we'll get one more day this week, okay? And I'm going to break out of that base. So all you do is spin your wheels here. And I think that's what it's doing. I think it's next to meaningless. I know every time we get one of these, there's a whole crowd of internet analysts that say, oh, I got to go to $40 or 41 or whatever, and this is this of the that and so forth. And I don't see it. I see it as a pullback buying opportunity. In fact, I'm making a list right now of miners to add to, because I'm shifting not just into silver related, but also the silver miners.
Markets look calm right now, but according to analyst Michael Oliver, that calm might be the silence before a financial storm. He believes silver and gold are preparing for a move that could shock everyone. Both metals have been consolidating, but beneath the surface, momentum is building, and it's only a matter of time before it erupts. Oliver points to one key number: $48 per ounce for silver. If that level breaks, he expects a surge unlike anything we've seen in years. Not slow, but explosive, possibly sending silver toward $100 to $200 in a short time. The real signal, he says, isn't the RSI or moving averages. It's the silver to gold spread. When silver starts outperforming gold, it's the early warning of a powerful bull run, and that signal is now right on the edge. Meanwhile, gold is quietly overtaking the stock market, a classic sign that big money is rotating out of paper assets and into something real. Oliver believes the stock market is topping out, showing the same weakness seen before the crashes of 2000 and 2008. With bonds failing and tech stocks stumbling, investors are starting to seek safety. And precious metals are ready to take that spotlight. He also warns that Bitcoin looks overextended. If it breaks below key levels, it could trigger a 30 to 50% crash, dragging tech-heavy markets like the Nasdaq down with it. In short, stocks are fragile, crypto is risky, and metals are about to wake up. This isn't the end of the bull market. It's the beginning of a new one. Thank you for watching. Subscribe to Fine Metals for more gold and silver insights.
Anybody, even an amateur technician, if you only looked at the spread chart, you could see the ceiling. You clear that and we're gone. The ballistic tone will change from accelerated price tone that we've had for the last, 5-6 months, where silver went from the 30s up to the 50s, boom, boom, boom. Then it will go into that next phase. And we're arguing that silver is about to do, again, waiting on that trigger level, spread silver gold, to go into a new reality. And it's not going to do it incrementally. It's not going to go from here to $150, $200 or something like that in a matter of, a year or so. It's going to do it rapidly. When mistakes are made by a market, the overpricing mistakes or underpricing mistakes, sometimes they're protracted. We see bubble tops sit up there and froth around for a long time, and then finally they fall apart. And you look back and say, oh, gee, I should have known that. Okay. Similar at bottom. Sometimes markets get undervalued, and investors just say, phooey with that market. It's a dog. Don't touch it. And when it wakes up so fast they miss it. When that spread breaks out, it says something's beginning. Okay, it's not saying, oh, it's over. It's saying the race just began. And there's another spread that's very, very important, and that is between the gold measured against the U.S. stock market. And we've run numerous charts on that, especially last weekend's report where we went back to 2013. During that time, 11, 12, and 13, gold peaked and was headed down into a low that ended in late 2015. Well, obviously, during that time, gold was underperforming the U.S. stock market because it was really going down hard. And therefore, the spread was negative. Gold was underperforming. But since I actually go back 11 years now, about from 2014, that spread chart, when you divide the price of gold into the S&P 500 and express it as a percent and simply plot that chart month to month, has a massive, super clear ceiling on it that you're bumping and bumping and bumping. This is now for the fourth time, okay? Right now, the spread, if you divide gold into the S&P, is at about 58.5% price of D gold divided into S&P 500. If you ever close them, this is a fresh signal. Which when that occurs, it's not old. It's not saying, gee, I'm an old trend. It's saying I've just begun a major asset class shift. Now, when you do something else that we thought we should do in the weekend report, and sure enough, we were glad we did it. We know the S&P is distorted. It's like NASDAQ 100. In fact, you go to the top 5 or 6 stocks in both indexes, and you'll find that those stocks constitute 30% of the entire S&P 500. And you know what those stocks are. AI, tech related. NASDAQ 100, the same symbols, 4 or 5 or 6 of them, constitute 50% of that entire index. So they're heavily front-end distorted. When we divide gold into the Dow Jones 30, or divide gold into the New York Composite Index, indexes people seldom look at anymore, we've already broken out. Whereas you've had that breakout. What it says then is that with the exception of those couple stocks, and by the way, look at those stocks today, they're getting hammered. Palantir, NVIDIA, et cetera, far more than the market. We've got some trigger numbers below the S&P, percent or so below today's low, and on the NASDAQ that would say, uh-oh, you're probably headed down. Now, not disastrously. We think what's been going on in the U.S. stock market since late last year, in fact, is a topping process. We made our high in January, February for the NASDAQ 100, S&P. We had the headline sell-off, which you don't like. If you're a bear, you don't need a headline. You'll get them later. You know, this bank fails, this company fails. You don't want to hear it at the beginning. So we heard this tariff stuff suddenly became the be-all and end-all of the world. Now it looks like the Supreme Court might sort of push some of that aside, in which case that's not even an issue anymore. Well, let's get it out of the way, because frankly, the reason the stock market would top is not because of some headline, which Trump, of course, tried to solve by saying, oh, I'll give a 90-day delay, and so we had a rally off the April low. But making the new high, for example, in the S&P above the January high, we got another 10% or so above the January high. And now we're slipping off some. We think it's all part of the topping process. The same thing happened in 2000 and in 2007 when the S&P was topping. It made a high, looked negative enough for us to say, get out of this category, dropped, but then came back and made a new high, which was a teaser. Whereas if you succumb to the new high and thought, oh my, the game's on again. No, you were wrong. It was a trap. And in fact, the one in 2007 that made the new high was in October 2007, a few weeks after the Fed, surprise rate cut. We showed this over the last months, and especially back in a September report, we showed an overlay of the S&P 500 back in 1987, when it had been going up and up, and the price chart just looked lovely. You know, momentum had built a floor spanning a couple years where the price was going up, There was rising lows, but momentum was making the same low over and over and over again, where it was dropping down, the price was dropping down to its rising three-quarter moving average. And therefore, the oscillator showed a repeated drop to the zero line, okay, a flat floor, a structure. When it broke it, it crashed. Didn't even wait around for the end of the month close to break it. It broke it intra-month, gone. Okay. This is the fourth time that Bitcoin since 2023 has dropped down to its three-quarter average. That number this quarter is 101,390. Okay, we've been trading below and above that for the last few days, so we've come down to that structure again for the fourth time. We don't think it'll hold this time. The question is, do you wait for a close, monthly close below that number? We got a long way to go to the end of November. Or do you maybe assume this time, don't wait, it's not going to hold, just like an 87 for the S&P. That's our assumption. Now, does it have to crash? No, I'm not going to argue that. Crash meaning like 30%, a matter of a week or so. But it's a disastrous number regardless. And, it wouldn't shock me that when you break this, that 3 months later or maybe 3 weeks later, you see that the Bitcoin, which, by the way, is highly correlated to the month-by-month price action of NASDAQ 100, is 30% or lower below where we are now, meaning you could be 70,000, 60,000 or something on Bitcoin. Remember, its recent high was 127. It could cut you in half, much of it occurring rapidly. Now, the problem with Bitcoin doing that, aside from proving to the gold doubters that Bitcoin is an alternative to gold, which it is not, but it's linked to the stock market. Its inhale-exhale behavior since 2021 on Bitcoin monthly bar charts versus NASDAQ 100 is practically an overlay. They look like brother and sister. In fact, we ran those charts and removed the name on the chart and the price scale, and you can't tell the difference hardly. So if that Bitcoin breaks our structure, and it's down to it now, if you break it credibly, like a monthly close, or don't even go lower than what you've already done the other day, like 99,000. It's likely to have a wave impact on NASDAQ 100 because the same speculative inhale-exhale fever is going on there. And sure enough, all norms of technical analysis like RSI and so forth will be a total falsehood if you follow them. In other words, once you get silver up to a monthly RSI that's overbought, if you get out there, you're going to miss the move. Even back in, I think it was 79, you got monthly RSI above the what is the overbought level, stayed there for like 5 months. In other words, you should have bought the overbought level because it stayed there for 5 minutes, it exploded. In other words, all the norms get smashed. We have a situation in silver where for some reason, and one reason may be the artificial suppression of the market by certain banks, maybe inclusion with central bank, I don't know, where it stayed in a 50-year range. You go back and look at copper or lead. We ran those charts a few weeks ago, you go back to the 1970s, and you'll see that they were in a range, 1970s, 80s, 90s, into mid-2000, like 2005 or 6, where they were stuck in this orderly reality, up, down, up, down, up, down. And when they came out of it, literally in a few quarters, they quadrupled in price. These were different times. They weren't doing it together. Copper went up in like 2005, 6. Lead went up in 2007, so it wasn't the same driving force. But they quadrupled in price. And then since then, they've lived in a new zone of reality that's like 4 times the average price of that prior zone of reality. How come silver's still in the prior zone of reality? Look at gold. I mean, where was it in 1980? $850. Silver was 50. Okay, where was it in 2011? 1920. Where was silver? 50. Gold's 4,000. Where's silver now? 48? Okay, what's going on here?